No matter how much downward pressure Trump is putting on rates, they are still sitting right now at near 6%.
He's going to get his way. He's going to push these down. There's trillions of dollars sitting in this 2 to 4% range, right? I'll call it 2.5, let's say. There's trillions, right? So he's got a ways to go. He's got almost 2 points. And for those of you who know, rates were at like 3.1 in January of 2022. And they doubled in 9 months, okay? So we are about where we were at the end of 2022. So rates have come back. They've come back to earth a little bit in the last year. Obviously, we got some rate cuts now on the Fed side. But to your point, they're still in the sixes. And so there's all this unlocked, tapped equity that will really, really be good for the economy.
Yeah, and you have to remember that this is the lowest rates have been in about 3 years. So they are trending downwards. They're just not, people got so used to rates moving so quickly because they move so quickly down and then they move so quickly up. But now, this slow, gradual move to the bottom is more normal.
Now let's look at a couple softballs that could really, I guess, throw a wrench into all this. The first one, of course, is inflation. Okay, because when inflation went up to 9.1% in June of 2022, the Fed responded by raising their rates from 3.1 and up, and they basically doubled in 9 months to compensate for high inflation. So right now we got inflation just a little bit under 3%. The Fed's target is 2%, so they're not quite at their target. But if we do see inflation, that could flatline interest rates through this year.
Yeah, what you're essentially saying is that if we see inflation go up, then that is going to be a problem for them.
It'll be a problem. It means that this 6% mortgage rates might not change much. In fact, they could even go up, right? Like just like they did. Now they probably won't because again, they were at 3.1 in January of 2022, right? And then they more than doubled. And that's, so we're not that far off of where we were 3 years ago. We're at a 3-year low, of course, and that's good. But the reality is higher inflation could throw a wrench in this whole thing, right? And then you got unemployment, which is a whole nother thing.
But also, you bring up unemployment, but the unemployment is downward pressure on inflation because if people aren't spending money, then things go down in price and things, you have a lower inflation bar. So this unemployment continuing to go up is really setting us up for lower inflation. And also, the Fed has to decide between focusing on unemployment or focusing on inflation as far as rates go. And historically, they have focused on unemployment because they don't want any kind of big recession.
Yeah, and if you measure, where jobs are, there's 1 million more jobs today than there were 1 year ago available, right? That's year over year. So that's going the wrong direction as well. And, you can blame AI, and I'm sure that's a big piece of it. But it could also be inflationary where a lot of the employers, they're trying to figure out, just like you are, like look at yourself, look at an HOA. They're easy to take shots at. Why are your HOA fees going up? Because costs are up. Costs are up for employers too. Employers are trying to figure out ways to cut back. And so, higher costs do ripple. This is the lag effect. And if costs are up, then, what happens? Employers say, let's see if we can, we can add more work to existing staff or whatever. But, they're cutting back right now to try to become profitable.
Yeah, and you have to remember, too, there's weaker consumer spending in general, right? And weaker consumer spending leads to lower amounts of inflation. Part of the reason, or most of the reason, we had such massive inflation in 2020 was people were getting stimulus checks and they were spending them. That was like one of the main reasons, that we had the inflation in the first place.
Yeah, so what was interesting, if you looked at personal savings rates during that time, like just Google that, like on Fred, the St. Louis Fed, just Google personal savings rate and you'll see it spiked. When everybody got all that money, it went way up.
Yeah.
And then what happened after that? It went way down. They spent it
Yeah.
And then what they do, they start getting in debt. And as you know, the credit card debt just is rocketing up. It's ridiculous. Like, it looks like a hockey stick.
Yeah.
It's bad. I mean, people are getting more and more in debt. So what's happening is they haven't really had any behavioral change.
Well, but they're the things that they're spending money on, groceries, rent.
Starting to now.
Yeah.
Yes,
they can't afford it.
And you're seeing it in like malls, like these, these retailers, they're people are shopping online too. Yes, I get that. But yeah, some of these big retailers, these big brands are in trouble, right? People aren't, the discretionary money is not flowing around like it was.
Yep. And then the other thing that you have is that Trump just appointed a new chair to the Federal Reserve, Warsh. And he, he's more conservative, but let's be honest, Trump is going to appoint who he has discussed cutting rates with.
Oh, yeah. I mean, yeah, we knew this was coming, right? He just was throwing Powell under the bus as much as he could. No, those two, which is interesting because he appointed them.
Right. Well, I was going to say the same thing could happen with Warsh, right?
Oh,
because
trust me.
One thing Trump hates is he can't fire these people after he appoints them. So
all he can do is badmouth them in the press, right?
Yeah.
Which is why his ratings are low. He wants rates low. And if the guy doesn't deliver, you watch, the gloves are going to come off, and it's going to be very interesting to see the battle between these egos.
So we also have to look at the Treasury and bond market because those really do also drive interest rates. Now, I know everybody thinks that the rates are completely detached from the Fed and they're completely dependent on the bond market. But the truth is last year, every time the Fed lowered rates, lending rates went down. So, yes, they're tied to both, let's say. But the bond market is important because even if the Fed lowers rates, the bond market has to cooperate.
That's right. Yeah. And again, the Fed, they have a dual mandate. Of course, we've already talked about this, but one is inflation and two is unemployment, right? So that's what they use typically. And don't forget, there's, 13 governors, I think, that are underneath the Fed, and they all vote. And so there's some really, really cool things that you can look at. Number one is there are notes that each Federal Reserve bank has. And I've read these and they're fascinating, actually. They focus on their geographical area. And this is why I think I don't think there's corruption inside of the Fed personally. I think what happens is you have each person comes there and they're looking at their geographical area, and there's these Fed notes. They're very, very, very cool. That all rolls up to what's called a dot plot. The dot plot basically says this is how the different governors are going to be. Is it governors or chair? I can't remember, but how they all vote. And essentially, and it kind of shows you where their head is, right, based on their particular region. Because what's in Kansas City is very different from San Francisco and very different from Philadelphia, and you guys kind of get the point. Very different from Dallas. So every person comes with their own perspective, which is, I think, a good thing. And so the chair, while they're still the chair, they also have to deal with the whole committee. So this is not something that and of course we are supposed to be completely independent. The president is supposed to be completely independent of the Fed.
Now, the biggest thing, though, is that in the past, the Fed has done some kind of quantitative easing where they're buying those mortgage-backed securities. Now, I don't know if Warsh is going to do that, but Trump has already put Fannie and Freddie in the position to start doing that. The thought of him mentioning it had already lowered rates, right? So if they actually start buying mortgage-backed securities, obviously that helps, get rates down as well.
And let's talk about how we got here, right? Because, Fannie and Freddie got in trouble in 2008. So, Freddie Mac and Fannie Mae, as you guys know, they're not nationalized, but the government bailed them, and then they fixed themselves, and they ended up getting quite a bit of money on their balance sheets, and so they were highly profitable. And Trump saw that cash. He's like, okay, $100 billion each. you're going to start buying these mortgage-backed securities. And what that did is it drove rates down. And by the way, let's take a look at this. There's a lot of people that are refinancing right now.
Mm-hmm.
And it helped.
Yeah.
Right. I mean, you and I both did refinances. We just did a refinance on a big project in Flagstaff, a 267 unit project. You did a refinance on a property that you have a lot of equity in. You pulled some equity out, right?
Yeah, and I'm waiting. I think a lot of people are also waiting on other properties. I have one that's at 6.9%. Doesn't make sense to refinance yet, but if rates can get into the mid fives, then it does make sense for me to refinance into a lower payment. And truthfully, doing that will probably make it cash flow.
Well, I refinanced at 5.5.
Mm-hmm.
So depending on your relationships and whatever it is, I'm telling you, you guys can get into the fives right now. And we're underwriting our multifamily deals in the fives right now for Fannie and Freddie debt going forward. So that is commercial, of course, but the reality is decent, right? Well, I mean, if you can't make a deal work at 5.5, then it doesn't work.
Well, and right, because those are more reasonable rates, and these 6% rates right now, they've started to bring buyers back. Like the market has picked up since rates were higher, but they're not quite low enough. People are teetering, they're thinking about buying, they're considering it. Investors are considering investing. But if rates continue to go down, I mean, even half a point to a point, I think that brings a lot of people off of the bench.
I think there's a psychological barrier if it goes below 6.
Yeah.
Right? For a lot of people.
Yep.
Right. They're going to say, okay, it's within reach. So if you're in your low 5s or high 4s, it might be something you consider, right? Especially if you have a lot of equity. It's possible you don't because you like the low payment. And in Danille's case, she has a deal that's like under 3, right? So it has a long way to go. But there's a lot of people sitting in the 4s. And so if you're in your 5s at least, you're like, okay, I'm like a point and a half away, perhaps. But we have a long way to go. I'm just going to go on a limb here and say that I think that the Fed's going to have to lower their rates by at least a point to a point and a quarter for people to really unleash. And what does that mean? That means 4 or 5 different Fed, or it could be one at half a point, but 4 or 5 different Fed meetings. And that's going to take most of this year. So, at the end of the year, we could be in the low 5s would be my guess. I would bet that you're going to have rates come down at almost a full point sometime this year.
Also, you have to remember, this is going to help people that bought in 22, 23, 24. So these people that are sitting like me in a 6.9, 7.5% rate, being able to refinance out of that is going to save some investor deals. It's going to allow some people that are really stretched on, their monthly payment for their house to kind of be more comfortable. And it's also, like you said, it's going to make people, buyers right now, psychologically, they don't want to buy because rates are too high. So if rates come down and prices don't adjust, then they basically have to ask themselves, do I want to buy or do I not want to buy? There's really, unless you think housing prices are going to go down significantly, it kind of removes those barriers to entry for home buyers, is I guess what I'm saying. Because right now it's all about the rates. I'm waiting for rates to go down. I'm waiting for rates to go down. Okay, well, once they're down, then what are you going to do?
Well, right. So here's the thing. I'm always buying, as you guys probably know. Like I mean, do I want low rates? Of course. Do I want low prices? Of course. Do I want it to cash flow? Of course. Okay. But if I'm in the business, I finance stuff at 7.5%, right? So when I trade out a 7.5 for a 5.5, I've got 2 points. That's a lot. So my payment goes down by 2%. That's a lot. So I did it, of course, and guess what? If it happens again, if it keeps going to 4.5, I'll do it again. Mm-hmm. I just ratchet it down, just like just like a ratchet. Just ratchet, and you want to get this thing as low as you can, and make sure you fix. But so yes, I'm at 5.5 today, but in a year, if it goes to 4.5, or maybe even longer, maybe I wait. If it goes into threes, I'll lock it again. And I'm not selling the real estate. I'm literally just doing a refinance and try to get my payment as low as possible. Because when my payment goes down, and my cash flow goes up, all things being equal, right? So that's the whole game here. So you want to make sure if you're cash flowing at 7.5 and you're happy with the deal, great. It's 5.5 makes it better. Same deal. You don't have to sell it. You just cash out refi. And if you don't cash out, that's fine too. Because you're just getting more cash flow. So that's the whole game here. And Danille's been looking at a bunch of real estate recently, and she's had to pass on all of it. I don't know. You looked at 15 or 20 deals last weekend, and at today's rates, nothing really cash flows. And so you got to pass.
Yep. The seller's got to give. And if they don't want to give, then you just got to pass.
Just move on. Right. And so there's nothing wrong with ratcheting rates down, nothing at all. You should, just continue to do it.